We're going to focus on exam technique. That's a very, very, very big thing when it comes to any past paper for any subject. The better you are with exam technique, the easier it is to do well, because at least you have some sort of strategy going into the actual exam. So what should you be looking at doing in the exam?
I think work with the questions you're more familiar with first.
Correct. So I would scan the question initially, and I would look at the long questions just to see what section B looks like. Because in this particular exam, it was 30 multiple choice, so 30 out of 70 for that section, and then 40 marks for the long questions. So the long questions actually count more in terms of weighting for the actual exam. So I would quickly go straight to the long questions and just have a look at what did they actually ask. Because if I'm familiar with the question and I've been looking at past papers and I've been doing revision, then it wouldn't be too bad to start with this question, so long as I don't go over time, because I still need to complete multiple choice. So I would be looking at something like maybe a bad debts, change of sales, and investment in account receivable, one of those questions where you're looking at the change in credit policy. I'd be looking for a budgeting question perhaps, or I'd be looking at something relating to maybe factoring or pledging, something along those lines. So if we look at question 1, we can see the first question here is focusing on financial statements. Okay, so we've got a comprehensive income for 2014. If I scan the required, they're asking me to perform an analysis in terms of creating a pro forma statement of comprehensive income and statement of financial position. Right. So this is actually a really simple question because it actually focuses more on accounting rather than finance. And the nice thing with this question is they've given you these templates from the previous year, which is 2014, to help you obviously create pro forma statements for the next financial year. Right, you can see the questions focusing on 30 December 2015. So that's actually not a bad question. If I saw this question in the exam in section B, I would have said, well, great, that's actually really, really, really nice, because it's more accounting than finance. You're just going to be drawing up the statements, but then providing for what they've mentioned here in the additional information. Okay, because remember, pro forma means a set of financials before the actual financials. Okay, then if we scan question 2, and they've given you the answer sheet as well. Here's it here, projected statement of comprehensive income. So even better, normally in the past they didn't give students answer sheets. They normally just give you answer scripts, and then you've got to create all of this. But it looks like they've provided you with the actual templates as well, which helps a lot. Okay, so this is a nice paper, not too bad in terms of templates and having to remember too much format. If we look at question 2, we've got a business here, and the focus looks like a budget. Let's check. Prepare cash budget. Yes. Alright, so if you look at this particular year, they haven't tested any pledging, they didn't test any factoring, they didn't test any change in sales or marginal investment in accounts receivable and anything along those lines that they tested in the previous exams. Okay, so the 2016 exams that we've looked at, that was generally the focus. Going back to 2015, we can see the focus is slightly different. It's more on the actual internal record keeping around financial management. Okay, looking at cash flow, looking at the pro forma statements. Right, so this paper doesn't look so bad. We haven't done a long budgeting question. We had a short one in the actual, I think May, June 2016, where we spoke about the cash and those types of things. I think the same question is actually in this paper, but we'll go through it and check. Okay, so looking at the actual long questions, this doesn't look too bad. If you wanted to, you could actually start with it, as long as you don't go over the time. So you would spend around an hour on the multiple choice and around an hour on the actual long. You need to allocate your time so that you do complete the paper. Sometimes students struggle with finishing, especially when they get involved in a very long question, and you can see there are 2 long questions in this one. Okay, so I'm just going to start with the multiple choice. The first few are theory questions, so I want to see if you would be able to answer these in terms of what you've covered so far, just as a general, let's say, revision, okay, of some of these concepts. So if we look at the first one, they're asking you about the best way to adjust for the presence of fixed costs when using the simplified approach, okay, for the pro forma statements. So how would we adjust fixed costs? Would fixed costs vary with sales?
No, fixed costs remain the same.
Correct, yeah. Fixed costs are constant, they stay the same. So we're going to then consider which option. So one is definitely out.
Yeah. Is it either 2 or 4?
Okay, which one? 2 or 4? Which one are you going with?
Break bonus. I would go with 4.
Okay, why would you go with 4? Because do you agree, if I'm looking at pro forma statements are based on the existing information that we've got.
Yeah.
Okay, so even when we looked at those section B questions, you saw in section B they gave you last year's statements and then they asked you to do the pro forma for this year. So are we going to break the firm's historical cost into fixed and variable? Definitely, okay, because we're looking at the presence of fixed costs in a particular business. So the cost that we have in terms of the total, so all the historical costs, those are then going to be considered either fixed or variable depending on what we've got. Okay, so I would also choose option 4 here as being the correct answer.
Okay.
2. Firm's operating cash flow is defined as, okay, so this is your OCF. Okay, OCF you've covered actually in 2 modules. You've covered OCF in FIN3701 and now you've covered OCF again in FIN3702. Okay, in FIN3702 it's generally an easier calculation to do because you're not drawing up all of those workings, okay, to actually get the OCF. It's mainly they give you something and then you have to adjust the amount. So here they're talking about either gross profit or EBIT and how we adjust it in order to get OCF. So how do we adjust EBIT or gross profit, either or, to get OCF? What are we going to do?
I think minus taxes and add depreciation.
Perfect, good. Okay, so you know tax is a relevant cost, so you have to take it out, and you know depreciation is a non-cash item, you need to add it back. So 3 is correct, good. Okay, what about the firm's increase in current assets relative to its current, total rather. So if I get more current assets compared to my total assets, meaning your current assets are greater than the overall assets of the business, does that increase return reduce risk? Does that reduce return increase risk? Which of these options are correct?
I think it's option 2.
Increases return and increases risk. Would it increase risk?
No, I think it would reduce risk.
Okay, it would reduce risk because you've got more cash on hand, right?
Yes.
So you've either got 1 or you've got 4 to consider. Okay, because remember, we're looking at companies that have bad cash management are the companies that go bankrupt, not the companies that make a profit or don't make a profit. It's all about managing the finances of the business. That determines how sustainable a business is. So when looking at current assets, it also depends on which current assets you have as well. Okay, because did they specify what current assets they have?
No, they just said current assets.
Exactly. Okay, so do you agree inventory can be a current asset?
Yes.
And so can bank, which is cash. Right, so if I'm looking at inventory, if I hold more inventory relative to my total assets, does that increase or decrease risk?
It increases risk.
Yeah, that would actually increase risk because inventory can't always be sold.
Yes.
Okay, which is problematic. So they should have been a bit more specific here, because on the other hand, if I increase the cash, which is the bank, if I have more bank or cash in the business, that's going to affect the current assets relative to the total assets. Will that reduce risk?
Yes.
It definitely would. Okay, so having more cash on hand would definitely increase the amount of liquidity in the business, which would actually affect the overall risk of the business, because now we've got so much cash on hand, we don't have to worry about not having to meet our obligations. Okay, so I don't particularly like this question. You can probably refer to the memo that I sent you guys previously for all the exam papers. I would have mentioned that as well there, because they weren't specific when it came to the actual defining of current assets. They should have rather substituted the word current assets for something.
Yeah.
Okay, if they said if the firm increases its inventory relative to its total assets, well then your return would go up or down.
Your return would go up, but it would increase your risk.
Yes, okay, it will increase the return but increase the risk. Okay, because if you're stocking more inventory, do you agree? When we covered EOQ, we spoke about making purchases of inventory. And obviously, if we buy bulk, it's cheaper than buying single. Yeah, and also effects of inflation. Okay, if we're stocking inventory, we might be able to get better prices now than in the future, because generally, according to the economic principles, inflation is present, okay, in the economy, so we would expect the price of goods and services to increase over time. It's not always the case, but that would be our assumption. Alright, so I focused here on the actual cash, and I went with number 4. Okay, so I used cash here as the assumption. Right, so I assumed the firm is increasing its cash, which is the current assets, relative to its total assets. So I went with 4 here, because if I hold more cash, it definitely reduces risk, but it reduces return because you're not investing it anywhere. Okay, because we're looking at short-term working capital management. Okay. Right, so that's my only reason for going with number 4, is because I assumed that the focus was more on cash rather than anything else. Because we could even take this further and we could discuss other current assets like debtors. Is debtors a current asset?
It's a current asset, but it will increase your risk.
Yes, it would increase the risk, and what would it do to the return?
It will increase return as well.
Yes, okay, because your debtors could be charged interest, right? Your debtors would have sold. Well, you would have sold in advance. Okay, so you're selling now, but you're receiving later. Okay, so it definitely increases return, but it obviously affects the risk. Right, so there's a lot of different options here. It's difficult to say which one they're actually wanting you to go with, because they're not specific around what are the current assets. Okay. Right, as long as you're comfortable interpreting the question, so always take it back to those things and try to look at the cash flow or the effect of cash flow on the business. Okay, number 4 was a nice question. Good practice question here, asking you to work out inventory turnover.
Okay.
Do you remember the equations? Which equations are we going to need here for inventory turnover?
Can't remember the equation.
Okay, so do you agree the focus here is on the cash conversion cycle, right?
Yes.
Okay, but they specifically asked you for the inventory turnover. Okay, so if they're specifically asking you for the inventory turnover ratio, we're going to need the relation between average age of inventory and inventory turnover. Okay, so if I show that, let's put a working there. That's the formula that I'm going to need in order to do the calculation. Right, 365 over inventory turnover is my AAI. Okay, that came out of the textbook. On one of the pages in the earlier chapters under ratios, this is actually a bit of revision from FIN3601. Okay, 2601 covered the ratios in more detail. This question requires us to use one of the ratios from before, and that's the formula that I'm going to need. Okay, so I've given you the equation. Let's see if you can work out the answer.
Okay.
What did they give you in the question? What figures can you pull out?
The average age of inventory is
which was?
101 days.
Exactly. Right, so is it possible to work out the inventory turnover?
Yes.
Yes, okay.
Which is 3.61.
What did you get?
Which is 3.6139.
Correct, yes. Okay, option 3.
Okay.
Right, coming back to the question. Question 5. Which of the following will not cause an increase in the net working capital of the firm? Okay, so net working capital is obviously looking at what? Current assets minus current liabilities. Net working capital, remember the definition? Okay, so we're looking at which of the following will not cause an increase in net working capital, meaning all of them are going to cause an increase. It's the one that doesn't, which is the one that we're looking for. Do you agree?
Yes.
Okay, so would inventory increase net working capital?
Yes.
It would, because this is going to go up. Net working capital is equal to CA minus CL. So if I increase the current assets, what do I do to the net working capital?
You increase it.
I increase it as well. Okay, so inventory is a current asset, so it would go up. Okay, so that does cause an increase. Number 2, short-term investments. Well, what are short-term investments classified as? A current asset, right?
Asset, yeah.
Okay, so if the current assets go up again, does the working capital change?
Yes.
Yes, so in that instance, net working capital also goes up. So same as the first one. Okay, average accounts or accounts receivable, if that goes up, this goes up. So does that. Does that cause an increase?
Yeah.
Does that cause an increase?
Yes.
Yes, it does. Okay, and then number 4, average accounts or accounts payable. Right, so if the accounts payable decrease, meaning if this figure goes down, what happens to net working capital?
It will go up.
It also goes up, yes. Okay, so all of these are going to increase net working capital. Right, so there's a problem with question 5, okay, because all of these options will increase net working capital. Okay, we just spoke about that one, the next one, the third one, and the fourth one. Okay, I've even shown a diagram here for the last one. Right, so here I assumed that the current liabilities were 10. Okay, and then I said if the current liabilities had to decrease to 5, what happens to the net working capital? We can obviously it increases. Okay, so all of these options are correct. They all increase net working capital. Okay, so you can't choose an option in that question, okay, because they're all increasing net working capital. We just needed to apply the theory to the equation, that's all. Okay, so I don't know which option to choose there. That is a problem question. Okay, question 6. This one's not too bad. You're looking at net fixed asset investment. Okay, the N NCI. Okay, which is the non-current assets. Remember, fixed assets, non-current. So in your textbook, okay, or study guide or notes even, okay, in your notes, we spoke about the equation for NNI. Okay, I'm going to give it to you. Okay, you might have forgotten it because it's been a while since we've done these, and you're writing finance only in June, which is far off. So I'll help you with the equations, but then you can do the working. Alright, so NNCI is the net non-current investment, and that is equal to the net non-current change. Okay, so when we say non-current, we're looking at long-term, okay, plus the depreciation. Alright, so what answer are we going to get then?
Okay. It's 2 million.
What are you going to do, Melanie? Give me the working.
I took 2 million.
Good.
And you add 2 million minus the 1.8.
Okay, so 2 million minus 1.8 gives you?
It will be 200,000.
Yes, and then?
And you add the 200,000 because they're asking you for the 2012 investment. Am I right?
Yes. Okay, so you add back the 200,000 for the depreciation.
Yeah.
And you land up with 400, option 4.
Okay.
Good. Okay, so yeah, not so bad there. You just have to identify the correct figures, then substitute and solve. Okay, question number 7. What's the focus here? Theory, hey?
Yes.
Right, and they're focusing on the aggressive financing strategy. Do you remember what the aggressive financing strategy involves?
No, I can't remember.
Okay, aggressive means you seek finance when you need finance.
Okay.
Okay, so conservative means you're going to take out all the finance today and it'll cover all your operational risk. Okay, or operations in terms of expenses and so on. Okay, so conservative is you want all the cash on hand so you don't have to seek more finance. Aggressive means, well, we're not going to worry about it. When we need finance, we'll get finance.
Okay.
Okay, so the firm is using the aggressive strategy. They're purchasing a fixed asset. What is the likely consequence of this action? Which one do you think?
Number 4.
Increase in the net working capital. Okay, so if we look at the aggressive financing strategy, okay, to purchase a major fixed asset financed with a loan. Okay, what finance are we using to buy the asset?
A debt, long-term debt.
Short-term. It's aggressive.
Short-term.
Yes,
Okay.
It's aggressive. It's short-term. So if I'm buying a major fixed asset, what's happening to my long-term assets?
It will increase.
Exactly. Okay, because you're financing a fixed asset. Okay, so the first bit is obviously to consider that change. Okay, so fixed assets will increase because you're buying a fixed asset. Long-term finance isn't being used because this is the aggressive strategy. Okay, so the focus is on a short-term loan. And then we're looking at the current ratio as one of the ratios that we need to adjust or provide for. Okay, so if I'm looking at the aggressive, is the short-term finance going to increase?
Yes.
Yes. Okay, so the short-term finance is going to increase, which is going to affect the current liabilities. Right, so short-term finance affects the denominator. Okay, if the denominator is affected, does the answer get bigger or smaller? The answer gets smaller. Okay, remember, bigger denominator, smaller answer. Okay, because this loan is going to affect that. Okay, the loan will affect the current liability. Notice your current assets aren't affected because you're purchasing a fixed asset. Alright, so we just needed to interpret that, and if I have a bigger denominator, I'll have a smaller answer. So then option 1 is correct, because option 1 talked about a smaller current ratio.
Okay.
Okay, next. Right, question 8, 9 and 10 I think you should be able to do because it's just an interest calculation. Right, so we're obviously looking at the amount of interest we're paying, and we're looking at the different rates that we're going to have for this particular company. Right, so I think number 1, well, not number 1, the first one and the second one, 8 and 9. Those two are easier to calculate. Okay, we'll discuss 10. You might have forgotten the formula for EAR. We'll recap that. Okay, but 8 and 9 are relatively straightforward. You just need to work out the interest and compare that to the time that they're referring to, okay, which is the 90-day loan. Right, remember this is a 90-day loan, and the interest is payable at maturity. Right, so they're looking at how much do we actually pay for in the actual first 90 days. What's the interest? So first work out the interest, then work out the rates.
Okay. Okay, my answer is option 3.
Okay,
I took the 2.5 plus the 16, and then the 300,000 times the 18.5% times 90 over 365.
Good, well done. So that's your principal times rate times time gives you the interest. Great, so now you've got that. Okay, so now question 9 is asking you about the actual effective rate for the year. Well, not for the year, for the 90 days.
Okay.
So how much interest do we actually pay on the 90-day loan in terms of a rate as a percentage of? Well, how much capital did you take out?
Okay. Do you have to use that formula, am I right?
No, not the formula. Well, it's sort of a formula. It's just, think about it. Principal times rate equals, principal times rate times time is equaling your interest, right? Okay, so do you know how much interest you've paid?
We've paid the 13,684.9315.
Correct. On how much capital?
300,000.
Yes, there you go. So all you had to do was take the interest and divide that by the capital as a percentage of.
Oh, okay.
Okay, so your option 2, 4.56%.
Okay.
Right, now they're asking you about the EAR. Okay, so this one I'm going to have to remind you in terms of the formula. Okay, you do need to know how to work out the effective annual interest rate, okay, which is that equation. Right, once I've got this equation, then all I need to do is just substitute into the actual formula. Right, so it's 1 plus the rate to the power 365 over n minus 1. Okay, it gives you a decimal. Right, then obviously the decimal will then be times by 100, okay, to get approximately 20%. Okay, so I just need to show the rest of the working. There's the rest of the working. Alright, so you're substituting in your 4.561643%. Okay, that percent that you worked out from question 9 goes into the formula for question 10 to then get an answer. Right, you do get an answer that's close to 20%. Okay, if you had to round it up to the nearest percent, you would end up with 20%. Okay, 19.83% is approximately 20. Right, so I'd be going with option 3 here as being the correct answer.
Okay.
Okay, so just remember the important formulas. These questions do come up quite often, and it's worthwhile knowing what they are, so the working is quite easy to do. Okay, so that was 10. Okay, you didn't have an exact answer here, right? But they did say this in the question, approximately.
Yeah.
Yeah, so that would be fine. Okay, number 11. This one's not so bad. It's looking at cash conversion cycle. Okay, they're talking about the annual outlays. Right, so there's 12 million that must be outlaid over the 60 days in terms of operations, and they're negotiating finance at 15%. Okay, the firm reduces its AAI by 10 days. Right, is that good or bad for the business?
It's good.
Okay, yes, because average age of inventory is being reduced, right? So we are going to be saving in the long run, okay, because you're not going to be holding stock as long as you would before. Okay, the average age of inventory. Okay, if the average age of inventory decreases, that means you're selling it sooner and you're not holding it as long. Okay, so we need to do two calculations. We need to know how much finance do they need for the 60 days, which is the current, and then how much finance do they need for the 50 days, which is the new scenario, and the difference is how much we're going to be saving. Alright, so nice question here. I'm going to show the working. It's not a very difficult working, it's just looking at the two different scenarios. Okay, so scenario 1, 60 days. Okay, so if I've got 60 days and I require 12 million at 15%, and I'm looking at over 365 days in the year, I'm going to land up with that answer. And then I do the same thing with 50 days. The difference is what you're saving, which is 49315. Alright, in the actual answers, they didn't give you a specific answer, but again, they said approximately. So if it's approximately, well then, to the nearest 500, that would be correct. Okay, the exact answer is 49315,07. Okay, right, so we're just looking at the difference. How much do we need to outlay in terms of the cost of negotiating the finance, okay, for the 60 days or the 50 days? The difference is what we're actually saving. And we need to look at everything in line with the 365 days a year, because that's what we're considering. Okay, we're considering over the time, okay, over the year, over the financial year. Right, 12 was theory. I think you should be able to choose the right answer here. So, which one do you think is correct? Thoughts? Okay, so a tip would be to write down the cash conversion cycle, because that's what they're focusing on, hey? Okay, so then I would be jotting this down. ACP. Okay, so AAI, ACP, APP. Okay, so I've jotted down the formula. Then I'm going to be looking at each option, and I'm going to be looking at its effect on the cash conversion cycle. Does that make sense?
Yes.
Okay, so which one do you think is correct?
I think number 2.
Buying raw material to take advantage of price decreases. Would raw material affect the AAI, ACP, and APP? Raw material would affect the operations because the raw material would be part of the manufacturing. Okay, remember the AAI focuses on the finished products. Okay, how soon or how quickly or how slowly the finished products are being sold. Okay, but that's once we've got them. Alright, so the raw material is focused more on the operational side of things, the manufacturing. Okay, that's internal processes. That's not the cash conversion cycle. That's more internal inventory management around operations. Okay, so yeah, I wouldn't be going with 2 here. Which other option do you think is correct? And another reason why, well, even if you did say, okay, so even if you did say the raw materials was going to affect inventory, right, let's say you're selling raw materials, well, even if you did assume that that was still inventory, what would raw materials do to the cash conversion cycle? Well, if that increases, what happens to the CCC? It also increases, do you agree?
Yeah.
Okay, so that still wouldn't be right, even if we assumed that you were selling the actual raw material.
Okay.
Okay, which other option?
Option 4 maybe.
Offering longer deferral period to customers. What does that mean?
Giving them the option to pay you later or something.
Correct. Which variable is that going to affect?
The ACP.
How would it affect the ACP?
Because it's to do with collections. Your collection would take longer.
Correct. So the ACP will increase. What will happen to the CCC?
It will be lower.
It'll increase as well. If you make ACP longer, that's also going to be longer, right?
Yeah.
If you add a bigger number, the answer gets bigger. Okay, so 4 is also out. So which is it, 1 or 3?
Maybe 1.
Okay, it's actually 3. Okay, foregoing a discount that are currently being taken. So do you agree what's currently happening? You're taking a discount. Okay, if you're taking a discount, what's going to happen to your ACP? Shorter or longer? If I'm taking a discount, is ACP shorter or longer? Not ACP, sorry, APP. If I'm taking discounts, is the APP longer or shorter?
Shorter.
Correct. Okay, so now if I forego the discount, what happens to APP? It gets longer.
Yes.
Okay, so if APP gets longer, that's a bigger amount. If that's bigger, what happens to the answer?
Smaller.
Exactly. Right, option 3. Okay, so when you get a theory question, just write down the formula and then just go down the list. 1, 2, 3, 4. Think about how would it affect the equation. That's all. Okay. Question 13 is the same as what we saw earlier. Okay. We spoke about the average age of inventory. Okay, we wrote down an equation. Right, so let me write down the equation. There's the equation. Okay, did the question give you the inventory turnover ratio? Is it there in the question?
No, not that I can see.
Yeah, it's not there. So how do I work out inventory turnover? See, there's another ratio. Do you remember inventory turnover?
We just wrote it somewhere, I think.
Oh no, we didn't write down that equation. We wrote down inventory turnover as part of AAI.
Oh, yeah.
Inventory turnover is a separate formula, okay, and it's looking at cost of sales over inventory. Did they give you the cost of sales? Yes,
No.
you can work it out. They said 80%, okay, of the
Oh, yes.
80% of the total is your cost of sales. Right?
Yeah.
There's it there. 80% of sales is cost of sales. So can I work out cost of sales?
Yes, you can.
Yes. Did they give you the inventory? Yes, they did. What is the inventory?
The 2.5.
It's half of its monthly cost of sales, not the 2.5. The 2.5 is the average monthly sales, not the cost of sales. Okay, so we first need to work out the cost of sales. So what is 80% of 2.5 million?
Is it 2 million?
2 million, yes. Then the question said it keeps inventory equal to 1/2 of its monthly cost of goods sold. So what's a half of 2 million?
1 million.
Exactly. Okay, and that gives you 2. Right, so is it possible now to work out AAI? Can I work it out?
Yes.
Yes. So what is the AAI?
365
No,
divided
360.
by...
The question said use 360 days.
Oh, yes.
So 180, hey?
Yeah.
Okay. Right, let's look at question 14. Okay, 14 is very specific theory. They talked about a locks box plan, okay, and then 15 is talking about the credit policy again. Alright, so these two are theory questions. Okay, lock box plan comes straight from the glossary of the textbook. Okay, it might be worthwhile just to briefly read through all of those definitions before you actually write the exam, because sometimes these very specific concepts come up, and you might have to choose one of these options. Okay, lockbox isn't really bad to choose in terms of an option, because think about it. Can you access a locked box?
No.
You can't.
It's locked.
Okay, so a locked box plan, okay, would be a way or a system of speeding up a firm's collection of checks received. Okay, method of safekeeping for marketable securities? No. Okay, that'll be marketable securities aren't kept in a safe. Okay, marketable securities are it's paper. It's like it's an intangible asset. Okay, slowing down the collection? No, you wouldn't be slowing down collection. You'd be speeding it up and then using to identify inventory safety stocks. No. Okay, a lock box plan is to system of speeding up the firm's collection of checks received. Okay, so was that right? Let me just check. Yeah, option 2, glossary. That was the one that was correct. Okay, so you could maybe eliminate some of the options and then land up with the correct one. Okay, 15 was also theory, so I'm just going to put that answer there as well. Let's do this. Right, so question 14's option was 2, just see the glossary, and then question 15 was 4. That was looking at relaxing the firm's credit policy. Right, both statements 1 and 3 are correct. Okay, if we relax the credit policy, do we make it easier or more difficult to take out credit?
Easier.
We make it easier. Okay, so it's going to stimulate sales, but it's going to create competitive pressure. Okay. Right, 16. I think we've looked at a question like this before. Was this the one? No, it wasn't. It was the other one. Okay, we'll get there just now. Okay, question 16. Alright, 16's easy. It's just asking you about the monthly cash float. Okay, so in April we had a cash balance of 350. Then we had cash receipts and disbursements of 400 and 500. And then at the end of May, the financial manager confirmed that the firm would have to borrow an additional 200,000 to manage the monthly cash flow given. Given this information, the company maintains a monthly cash float of what? Right, so what's the balance? 350. Did I receive cash? Yes. Did I pay cash?
Yes.
I then need to look at the net amount. Okay? And then I need to add the amount that's borrowed. Right, because do you agree borrowing is going to add to your cash flow?
Yes.
Correct. Okay, so this one was simple, straightforward, nothing challenging about this. You just had to work out the net, add the borrowing, and then you land up with 450 would be the float. Right, 17, just to help you with the formula, they're talking about the cost of giving up a discount. Right, there's the equation. Okay, I want you to quickly work out the correct answer. Let me put up the question. There's the question. Okay, so Dixie buys in terms of 350 net 30. Okay, so 3% discount within 15 days, net 30 days. Right, it does not take discounts and typically pays 50 days after the invoice date. The net purchases were 720. What is the nominal cost of giving up the discount? Assume a 365-day year. Right, so there's the formula. What's the answer going to be? Quickly work it out.
Okay.
Alright, tell me what the variables are that you're substituting into your calculator.
Okay, the discount is 3%.
Good.
Okay. So it will be 3%. That would be 0.03 divided by 1 minus 0.03 times 365 over 15.
No, not over 15. It's the days forgone. Remember, N is the days forgone.
Okay.
Okay, so what period are they wanting you to look at?
They take 50 days after. So it'll be 50.
Okay, so 50 minus 15. That's correct. Okay, then you should be getting that answer.
50 minus 15. Okay.
Did you?
Yeah.
Okay, good. Alright, so that's a cash discount question. Question 18, we've looked at a lot of these. Compensating balances.
Yes.
Okay. Think you can do this one?
Okay, yep.
Okay, it's not too bad. Hey, just remember it's a discount loan. Alright, so your denominator needs to provide for all the compensating balances, interest, and all of that.
Okay.
Okay, we'll check it just now, see what you get.
Okay. Okay.
We need to look at two things here, do you agree? We need to look at the compensating balance and we need to look at the interest, right?
Yes.
Okay, so what is the compensating balance going to be?
It'll be the 2 million times the 15%, which is 300,000.
Good. And what's the amount of interest going to be?
2 million times 14%, which is 280,000.
Correct. Okay, so you've got the two amounts. Now we just need to work out the rate. So how do we work out the rate? Well, because this is a compensating balance with interest, you're going to have a denominator that must provide for both. Right, so it's the interest over the net amount after taking off the compensating balance and interest.
Okay.
Okay. Right, so I think you might have left out one of them. You just subtracted the one, not the other.
Yeah.
Okay, possibly. Okay, question 19. What's the focus in 19?
Free cash flow.
Good.
FCF.
Okay, so free cash flow is the FCF. FCF is calculated from OCF and NNCI minus the NCAI. Right, so your net non-current investment and your net current asset investment. Okay, did the question give you OCF though? Do you see OCF in the question?
No, but they give us earnings before interest.
Exactly.
I mean, yeah, before interest and taxes.
Very good. Okay, so let's work out the OCF. We actually had a question earlier about OCF, remember? You had to choose the right option. So what did you say earlier? Well, we said OCF is going to be the EBIT minus the interest plus the depreciation, right?
Yeah.
Okay, so what does that give us? Quickly work it out. EBIT less the not less the interest, less the tax plus the depreciation. Okay, tax, not interest. I think I said interest. Okay, FCF is the EBIT minus the tax and then add the depreciation. Okay, it's EBIT before interest and tax. So you would actually have to subtract both interest and tax if you had interest.
Yeah.
Right, so just get the OCF first. What would the working be? What's your EBIT?
It's 100,000 times 30%, which is 30,000. Yeah. So that gives you 70,000. You add the depreciation of 50,000.
That gives you the OCF.
Which is 120,000.
Yeah, good. Right, that was the tough bit in this question. The rest is really straightforward because then you're just looking at a change in the non-current and a change in the current. Okay, so just to show that working, there's the answer. Not all of it is showing up. I need to move this across. Okay, delete that. There we go. Okay. Minus 30,000. Right, so it's the change in the long term and the change in the short term gives me the answer.
Okay.
Okay. Right, so the tough bit was the OCF. You had to interpret how to get it. Right, so option 1 there was minus 30,000. That's the free cash flow to the firm. Okay, 20. This is a rate calculation. What rate of interest do they pay on the notes payable? Okay, so when we're looking at a note payable, we're comparing the one to the... Did I leave a question out? No, I didn't. Okay, we're comparing the one to the other. Right, so the note payables is 1.546 million, and the long-term debt is 13 million. Okay, and there's a total interest amount of 1.3 million. That's the total interest. Okay, so do you agree the firm pays 8% on the long-term debt? They want to know what do they pay on the short-term debt. Yeah, this is actually more of a maths question than a finance question. Right, so do you agree the total interest amounts to how much? $1.3 million, right?
Yeah, 1.3.
Okay, so they gave us that. So principal times rate gives me interest. Do I know what the principal is for the long-term debts?
Yes.
Yeah, so can I work out the interest on that? Yes, I can. Okay, the interest on 13 million is how much?
times 8%. It's 104 point. No, let me say this right. It's 1,400,000.
Yes.
Am I right?
1,040,000.
Yeah.
Okay, so that's the amount of interest you're paying on the long-term debt. Okay, do you know what the total interest is? We saw it in the question. What is the total interest?
And the total interest is 1.3 million.
Correct. So how much interest do we pay on the short term?
I think we just subtract the 1,040,000 from the 1.3.
Exactly. Alright, and then we're going to have to work out the short-term rate. Okay, so the 260,000 is the difference between what you had, okay, long-term and short-term. Okay, so 1.3 minus that gives me the difference.
260,000.
Okay, and that's representing what? The short-term loan interest. Alright, if you solve for a rate, obviously principal times rate equals interest. You had these loans for the full year, so we don't need to worry about the time. And we would assume that the interest rate for this question was 16,8176%. Okay, option 4 is the closest. It's not the exact answer, but at least it's an option that we can go with.
Okay.
Make sense?
Yes.
Okay, let's look at the next one. That was question 20. Okay, so we've done that one, 16.8. Question 21 we need to look at. Okay, 21 is a very straightforward question. It's literally principal times rate times time. Nothing challenging about this. Okay, so I'm going to put up the answer. Question 20. Principal times rate times time. Add the two amounts together, gives you your total interest.
Okay.
Okay, that was very straightforward. Okay, question 21 was a bit more, let's say, involved, okay, because you had to consider the rate, okay, for the commercial paper, but it was the EAR, the effective annual interest rate. Okay, so when looking at the effective annual interest rate, I first need to work out, well, what is the actual rate? Do you agree?
Yes.
Okay, so how much interest do I pay on this commercial paper? It is issued at face value of $1 million, hey?
Yes.
Alright, and its current value is 991. So, do you agree at the discount loans, how much interest are you paying? R9,000 worth of interest, do you agree? Okay,
yes.
It's 1 million issued, okay, for 45 days at 991. Alright, so the effective annual interest rate, the first thing we need to do is work out the interest rate for the 45 days. So how do I work that out? I take my interest and I divide that by my capital. Okay, so 9,000 interest over 991 gives me that answer, but notice that's only for 45 days. Right, so how do I get the EAR? What am I going to use to get the EAR? We had that equation earlier, hey?
Yeah, 1 plus the rate.
Yes.
Yeah.
To the power?
And then to the power 365 divided by the time.
Exactly.
The 365 divided by 45.
Correct. Okay, so we need to put the answer here. Okay, 0.076086 is the answer after having substituted all of that into the calculator. Okay, so not so bad if you remember the equations. As long as you've got the equations, these are relatively easy or simple to do. Hold on, my numbering is incorrect here. Did I skip one? Or did I mess up the numbering? Hold on. 20. Oh, no wonder. Forgot to label this one. This is question 20. Okay, that's 21. And that's 22. Okay, sorry, the numbering was funny. Okay, so 20, 21, 22. Alright, so that's where we are. Happy so far?
Yes.
Okay. Alright, 23 is asking you about focus. What's the focus here? Nominal annual cost of the credits. Okay, so I need to then work out, well, if I'm looking at the current scenario, which is 4% discount within 30 days, net 90 days, the nominal annual cost of this trade credit, if they choose to pay on the 35th day, after receiving the invoice. Make sense?
Yes.
Okay, so they're deciding to pay on the 35th day after receiving the invoice. Okay, the net was 90 days. So the days that are forgone would be the
60.
The difference. Yeah, the difference.
Yeah.
The difference would be the amount. So let's write down that formula. Question 23. Okay, 4% discount times 365 over 90 minus 35. Okay, 24 and 25 were pure theory questions, okay, an increase in the APP. Okay, what does the APP do to the operating cycle? Well, what is the operating cycle? It's the AAI and the ACP. Does the APP affect it?
No.
No, it doesn't. It's option 1. Right, number 25, a philosophy of what is that the firm only have work in progress inventory. Right, that's just in time. Okay, it's just theory. Okay, where we only have work in progress. We don't have any stock sitting at the factory because holding stock is costly.
Okay.
Right, so question 24, question 25. Okay, question 26 was that one that we saw, I think, in the assignment as well. And then you actually got back to me with just adding everything up and subtracting everything, which I still don't agree with, but we'll go with how they've done it. Okay, what I would have done is I would have shown the actual when the checks are issued and when the checks are paid. I would have done that. Okay, so I'm going to show that working because we discussed this in the assignment when we did it. So I'm going to put the same working here. Okay, so obviously the checks that you're going to be making payments. Okay, so obviously they said in the question that the checks take a few days to clear, and then they also said the deposits take a few days to clear. Right, so when you receive or when you pay a few days later, it'll then be received or paid, depending on how many days. Alright, so if we do the simplified method, they said 15,000 a day was the checks. It takes an average of 5 days for those checks to clear. Because I think if I remember correctly, what you said was just total up and subtract. Okay, so the firm receives checks of 17,000 per day, and that's 3 days. Right, so then we would say 15 times 5, 17 times 3. Let's see if we get an answer there. 15 times 5, 17 times 3. Okay, 15 times 5 is that, 17 times 3 is that. Okay, which were my receipts? This is the pay, this is the receive. Okay, so the net would have been the receipts minus the payments. Ooh, receipts minus payments. 24,000. Is that right? Let's check. Yeah, 24,000 is there. What is the firm's net cash flows? The firm also receives checks to the amount of 17 per day, but the firm loses 3 days while its receipts are being deposited and cleared. Okay, the company writes checks averaging 15,000 a day and takes 5 days for those checks to clear. Yeah, okay, so I would be going with the 24,000. Okay, if we're just using that add and subtract story. Okay, so yeah, I don't quite agree with that because there needs to be a timing difference between the checks that you receive and checks that you pay. Okay, I'd be looking at a timeline, right? Because if I issue a check on day 1, the check will only be paid on day 6. If I receive a check on day 1, it'll only be received on day 4. Okay, then I looked at, like, so for example, 17 plus 17 plus 17 and so on. Okay, so that's the way I would have done it, but obviously they want you to do it a lot more simpler than that, and they just want you to add everything, subtract everything, get a difference. Okay, yeah, so 26 is 24,000 then, we would go with that one. 27, when should a firm's credit standards be relaxed? It's always when the benefit is better than the cost. Right, so option 1, when you contribute more profits than it's going to cost you to do. Yeah, that's a theory question.
Okay.
And 28 was another theory question. The focus here was the cash discount. Okay, so when a firm decreases or cancels the discount, what could happen to sales, what could happen to the investment, what could happen to the bad debt, what could happen to the profit, all of that. Okay, so it's theory. If sales is going to decrease, okay, it's going to create a increase in the investment trade accounts receivable, an increase in the bad debt, and an increase in the profit. Okay, it's option 2 here for 28.
Okay.
Let's do that. Question 28. Save. Okay, how are we doing? Okay, we've got another calculation. Alright, this was a nice question. We spoke about commercial paper earlier. Okay, did they give you the rate for the commercial paper? Yes, they did. What was the rate? 12.25%. Okay, and the maturity is how long? 60 days, right?
Yes.
Okay, what are they asking for here?
The value of the maturity.
Yes, the value of the commercial paper at maturity. Okay, so obviously, do you agree, if I'm issuing commercial paper and I'm selling it for 980, is the maturity value going to be greater or less than 980? Is commercial paper issued at a discount or not?
It is issued at a discount.
It is issued at a discount. So if you're selling it for 980, you're selling it at a discount. So what's the answer going to be? It's going to be any answer bigger than 980, right?
Yes.
Okay, so obviously they gave you options, which the only answer is 1, right?
Yeah.
Okay, but if you want to work it out manually, I'll show you how to do it. Okay, this is the working that you would do to get the answer if you had to do it manually. Okay, but obviously if you just think about it logically in terms of theory, commercial paper is issued at a discount. Okay, so if commercial paper is issued at a discount, right, the face value of the commercial paper will be greater than its current value. Right, that's just basic common sense, time and value of money. Right, so you have to choose option 1. Right, if you do it scientifically using the equation, I'm looking at the rate, which is that. Okay, the rate equals the 1 plus r to the 360 over 60 minus 1. Okay, I did all the mathematics. I got a rate of 0.0194313 dot dot dot. Okay, so what does that tell me? That tells me that the rate that I have is equal to the interest that I have to pay over the value. They didn't give me the interest because I need to solve for it, but they told me the value of the loan, which was 980,000. Right, so if I solve for interest, I get the 19,042 Rand, okay, with 67 cents. Right, then, therefore the maturity is going to be the interest plus the present value, okay, what I issued it at. Okay, so I sold the actual commercial paper at 980. I'm going to add the interest because at maturity, the full amount is going to be paid to the financer, or the person providing the instrument, the financial instrument. Okay, that's a very long way to get the right answer. If you just kept it simple and you just thought about it logically, commercial paper is issued at a discount, so the future value must be greater than the current value. Okay, is the theory alright? The theory is important. If you can't do the math, it's not so important, because you would have still have been able to get the right answer.
Okay.
But there's the solution if you need the longer version of it. Happy?
Yes.
Okay. Question 30. The key input to the short-term planning process. Okay, that's theory that came straight out of the textbook. It's option 4.
Okay.
Okay, and that was the multiple choice. Right, the multiple choice actually takes quite a long time, okay, because you've got all these calculations that you need to do. Right, the long questions actually aren't so bad. That's why when I spoke about that earlier in terms of exam technique, because they gave you budgeting here, and because they gave you forecasting, the pro forma statements, this was actually a nice section B, because you didn't have to worry too much about all of those equations that you had in some of the other past papers, where you had to look at a change in credit policy, okay, or pledging and factoring. Alright, so the long question. Sorry, do you have a question?
No.
Oh, okay. Alright, so looking at section B, we're focusing on Chromium Limited here for 31st December 2014. Right, they've given you a statement of comprehensive income. Here's it. And then they've given you a statement of financial position. There's it. Okay, notice that was for the 31st of December 2014. Right, that would have been for the last financial year. Okay, then they talk about the following additional information relates to the firm's projections for the 2015 year. See, there's the new year. Okay, so this is all of their assumptions that you have to apply to the original statements. These are the original statements. Are you going to adjust these figures?
Yes.
Okay, because it's pro forma. So you're looking at what the current situation looks like, and then you're providing for these adjustments. Okay, so the firm's sales target is 330. Are you going to change the sales amount?
Yes.
Yes. Okay, they tell you that 20% is receivable. Okay, so what does that mean? Credit sales. Do you agree?
Yeah.
And
yes.
the other bit means cash. Okay, so must I split the 330 between cash sales and credit sales? Yes. So will I have debtors and will I have bank?
Yes.
Yes, I will. Right, then they talk about minimum cash balance will be maintained. Okay, so that's the amount of cash they'll keep on hand. Then they say inventory represents 32% of sales. Okay, so how do I work out a percentage of? Well, I just multiply the 32% by the sales. And what does that give me? Gives me the inventory. Do you agree?
Yes.
Okay. What else do they say in the question? Well, the fixed assets are going to be 20. Depreciation is going to be 15. Where does depreciation go? Which statement?
The statement of comprehensive income.
Correct. Okay, and the fixed asset will go to the statement of financial position.
Yes.
Right, the accounts payable represent 15% of sales. Simple. 15% of sales. There's the sales. If you take 15% of it, is that your accounts payable?
Yes.
Yes, accounts payable is a liability that goes to the statement of financial position. Right, then you've got no long-term debt will be retired in 2015. So what does that mean? Have we paid off any of our long-term debts?
Yes.
No, it says no long-term debt will be retired. Okay,
Oh
so
no,
how
it's
much is the
outstanding.
debt here? What was the long-term debt? 55. That was the 55 from last year. Is it going to be 55 this year?
Yes.
Yes, because nothing changes. You're not going to retire any of its debt. Okay. Right, then they said no ordinary shares will be repurchased. So will your equity stay the same?
Yes.
Yes. All of that goes to statement of financial position. Right, and the last point talks about the firm paying dividends. 50% of dividends is paid of the earnings. Okay, so what am I going to do? I'm going to have to do the statement of comprehensive income. I'm going to then calculate the profits. And then a portion of the profit is retained, which is retained earnings, and a portion is paid out as a dividend, right?
Yes.
Okay, and that's what I'm going to be doing. Right, so everything that you have here at the bottom of the question is the most important bit. All of this stuff that I've highlighted, circled, underlined, made notes for are things that I need to do to change this. So are all of these amounts going to stay the same? Well, some will, some won't.
Yeah.
Okay, it's the ones that change that I need to provide for. Okay, so I don't know, did you get a chance to do this question in advance?
No, but it looks like a nice question
It's
to
a
do.
very easy question, yeah, because it's more accounting than finance.
Yes.
Okay, obviously accounting and finance is linked and all of that because of decision making and we need information. Okay, but from a financial management point of view in terms of net working capital, okay, it's just projecting something going forward. Okay, so I'm going to show the answer then on the screen just so you've got it, but obviously I would go back and then try redo the question and then come back to check with the solution. Okay, that'll be ideal.
Because it's quite easy.
Yeah, it's very straightforward. Because, for example, what is sales going to be? Well, 330, that's all.
Exactly,
Okay, depreciation, did they give that to you in the question? Yes, they did. You're just going to change one figure. Alright, so any figure that needs to be changed will be changed. They've even given you an answer sheet. Here's the answer sheet here at the bottom. Okay, we spoke about this when we were looking at the exam technique. Okay, so I'm going to quickly just take each of these. Okay, I want to discuss one or two things here. Okay, so let me quickly take through my workings. Let's paste that. Okay, so here's the statement of comprehensive income. Right, so after you've done this, you should get something that looks similar to mine. Okay, gross profit. How do I calculate gross profit? It's sales minus cost of sales. Right, then you've got all these other operating income and expenses. Okay, remember the selling expenses, the general admin, the depreciation. You had to change the depreciation. That was a line item that changed on the previous year. Okay, the total that you get is 66,000. Okay, so your operating expenses is subtracted from your gross profit, and that gives you the EBIT. So that's another subtotal. Right, so if I take the gross profit, which is the 135, and I subtract the 66, I'm going to get the 69. Okay, then they gave us the interest, then we had another subtotal. Right, so if I less the interest, maybe I should add a word here, less interest, just to show the minus. Less interest gives me 57, then I less tax to get the 34. There's the net profit after tax. Okay, the adjusted net profit. Remember, this column over here is the Proforma. Okay, it's basically what you're predicting is going to happen in the next period. Okay, in 2015. It's almost like budgeting. Okay, you're projecting amounts going forward. Okay, just something to discuss. What did the question say about the net profit? How much do we retain and how much do we pay out?
We paid 50%.
Good.
As dividend.
50% is paid, so the other portion must be retained. Okay, so just to show that 50% is a dividend, half of it is the retained earnings. Okay, where does retained earnings go? It's disclosed in the statement of financial position under equity. Okay, Okay, so don't forget to put things like that in the statement of financial position.
Yeah.
Alright, so that's the answer for the statement of comprehensive income. I'm just going to draw up the statement of financial position quickly just to show you what that thing looks like. Let's copy that and let's record that here. Okay, so here's the solution for the statement of financial position. Okay, you'll have assets, you'll have current and non-current. Okay, so your total current assets amounted to this. Again, you put in the non-current assets, total current and non-current gave you that. Okay, so there's my first section of the statement of financial position. I look at my current assets, I look at my non-current assets, I total up, and that was the final total that I got. 343,250. Okay, the question also requires me to draw up a liability and equity section. Okay, so here I need to work out the current liabilities. Right, remember I'm using the format that they gave you in the actual answer sheet. Okay, the format I'm using is this. It's here. It's straight from the question. Where is it? No. Further up. There's it. Went past it. Okay, so obviously in reality, these statements may look a little bit different to the statements that you've got here. Okay, normally when drawing up an accounting financial statement, statement of financial position, you normally see equity over here. Do you agree?
Yes.
Okay, so the format's a bit different. Don't worry about the different format, just follow the format that they've given you.
Okay.
Okay, so I've written down all of those headings and totals and all of that, and that's how I've got this solution. Okay, then I just followed the information in the question. The question said 15% of sales is accounts payable. That's how I get the 49. Okay, all of these amounts come straight out of the additional information which we discussed earlier. Okay, something I want to show you here is the retained earnings. I want to highlight that. Okay, this amount will change because this year's retained earnings or retained profit or earnings, either or, will be added to last year's or to this year's starting balance. Last year's end balance is this year's starting balance.
Yeah.
Okay, so that was what I highlighted earlier over there. Okay, the retained earnings. So this 70,100 needs to be included here in retained earnings. Right, and if you've done this correctly, which I have here, you'll see that my total equity and my total liabilities add up to 343,250, which is the same as what we had there. Right, so if you're getting these two figures to add up, then you've done the question correctly. Okay, so that amount must balance with that amount. But if it doesn't, then there's a problem. If it does, then you've done it perfectly. Okay, so I like this question, and it's an easy question because, as I said, it's more accounting than finance. And you can also check if you've got things correct or not. Right, if it didn't balance, then you know there's a problem. Okay, and why does it balance? It's because the external financing required, this is the balancing figure. Okay, you're working out the external finance. This is how much financing is expected for the next period. Okay, so we're going to be utilizing 288,250 external finance in order to run this business. Okay, so obviously the statement of financial position needs to balance. The missing figure is the balancing figure. So it was a nice question. It was very straightforward. It was very simple. October, November 2015 was actually a very easy paper, as long as you're comfortable with this whole idea of budgeting. Sometimes students struggle with it, sometimes students don't. It all depends on the student's ability to deal with the mathematics. Okay, can you adjust certain figures? Right, so depending on your view and depending on your ability to cope with the maths, sections like this should be relatively easy to do because there's no real, let's say, studying in terms of equations and formulae here. It's all literally, can you really interpret what's in the information, and then can you adjust and provide for it in the actual question.
Okay.
Does that make sense?
Yes.
Okay. Alright, we've got one more, okay, and then we can tick question, or not question, the past paper, October, November 2015. Alright, question 2 was just as easy. It was shorter as well. It was only 50 minutes. Okay, and it was focusing on budgeting. They said, prepare a cash budget for the months May, June, and July. Alright, so what do I need to do? I need to draw up columns for May, June, and July. Okay, so what does a budget look like? Well, a budget's going to have a section for receipts and payments.
First months.
Yes, all the months, correct. Okay, so there's the cash budget. We're looking at those months. Okay, so we need all of these columns. Ooh, copy. Okay, alright, so that's the scenario. Then I've got sales. Okay, the question spoke about sales, so we need to go back and we need to read that. Okay, they said right at the beginning, forecasted sales for May, June, July are this, and that. The firm has an opening balance of 40 on the 1st of May and wishes to maintain a balance of 40 during each month. Okay, that's important because that's the cash flow. Right, this business wants 40,000 every month on hand in case they need it for operations. Right, then they said the following additional information also applies to B. Okay, they've given you all of that information. Okay, so what must I do? I need to apply the information to a budget. Okay, so the first point says 25% of sales is collected in the month of sale. 50% is collected in the next month, and the remainder is collected in the second month following the month of the sale. Right, so can I analyze my sales? Yes, I can.
Yeah.
Okay, so I'm going to take the sales, and I'm going to show that here. Okay, there's my sales for March, April, May, June, July. That's what we read in the question. Do you agree?
Yes.
Okay, so we need to look at, does March affect May?
Yes.
How does March affect May?
Because of how the collections work.
Good, so what are we going to collect in May from March?
The balance of the 25%, I think.
Okay, so do you agree May is what month in terms of March?
The second month after.
Okay, well, April will be the second month after March. May will be the third month. Okay, March.
Yeah.
Okay, no, let me rephrase that. March is the current month. So April will be the first month. May would be the second month.
First month.
Is that right? Do you agree with that?
Yes.
Okay, so 25 is collected in the month of sales. So if I'm looking at March, 25 is in March. And if I'm looking at April, 50 is in April, right?
Yes.
And then obviously the rest in
May.
May. So if you've got 25 and 50, what's left over?
25%.
Exactly, 25%. Alright, so what's 25% of 400,000?
It's 100,000.
Exactly. Okay. April sales was 480. Do I collect any of that in May?
Yes.
How much in May?
50%.
Exactly, half. Good. Okay, and then how much in June?
In June will be 25%.
25%, exactly. Good. Okay, next one. Sales in May. How much is collected in May?
May 25%.
June?
50%.
Good. And July?
The 25%.
Exactly. Right, and that's how you do a cash budget in terms of forecasting. It's very straightforward, it's very simple, you just need to interpret correctly. Okay, so June sales. How much do I collect in May?
June sales, nothing.
Correct. How much do I collect in June?
25%.
Good. And then July?
50%.
Exactly, half of it. Right, and there's June, there's July. Okay, July, I don't collect anything in May and June. I start collecting in July, and I start collecting how much? 25%.
Yeah.
Okay, and there's it. There's everything. Right, you just need to look at any other income if there is. I think there was in this question. Did they talk about other income? Yes, they did. Okay, the firm receives. So now we've done that point. I've done point number 1. I can tick it. I'm happy with it. I can move on. Okay, the firm receives other income in cash. 16,000 per month. So I need to put that in. Okay, so other income, 16, 16, 16. Every month. 1, 2, 3 months. Right, and there's my cash receipts. If I total everything up, so if I add up all of that, I get 49. If I add up all of that, I get 57. If I add up all of that, I get 67. Okay, those are the totals for all my receipts. That's what I'm doing there. I'm just totaling up, adding up. Make sense?
Yes.
Okay. Then I'm going to have a line for my total payments. Okay, and then I need to record all my payments. Right, so we need to go back to the question, and we now need to look at the payments. Okay, so here they tell us the firm's actual purchases all made for cash. Right, so is this an inflow or outflow?
Outflow.
Outflow. Receipt or payment?
Payment.
Payment, exactly. Okay, so cash purchases, I'm going to take all of them and I'm going to put them there. Okay, that's what the question said, that's what I'm going to do. Right, next. The rent is 24 per month. Is that an inflow or outflow?
It's an outflow payment.
Correct. Okay, so 24,000 a month. I'm going to put that into my cash payments. Okay, so do you see how easy this is?
I wish I would get questions like this.
Let's hope so. I mean, if we looked, remember, we looked at 2016, and 2016 they gave you such a lot of those credit policy pledging stuff. Maybe they'll change it a bit. I don't know. We're going to have to see what they do. But if they give you a question like this, you would prefer this over any other question because it's so straightforward.
Definitely. Yeah.
It's more interpretation than anything else. Right. Next. Sales is 10% of the previous month's sales, and that's paid in cash. Okay, so salaries and wages. So, if I'm looking at the salary for May, the salary for May will be calculated based on what?
10% of the previous month's sales.
Correct. What was the previous month's sales?
April. 480,000.
480, exactly. Okay, divide by 10%. 48,000. Okay, should be a minus actually. Okay, so it's just the previous month. So for example, June. What's June's salaries? It's going to be minus May's sales times 10%.
Yeah.
Okay, and then the same thing for July. July's sales will be minus June's sales. Oh, sorry. I should have said July's salary. Okay, July's salaries is June's sales times 10%. That's the right explanation. Okay, it gives you 64. And that's it. Another line completes. Okay, go back to the question. Cash dividend 96 in June. Where am I going to put that?
In June.
Exactly. Next one. Cash purchase of equipment 48 in July. I'm going to put that in July. Go back. Continue reading. Depreciation. Do I put that in a cash budget?
No, it's a non-cash item.
Yes. Trick question. Right. Should I still put it in? I would. Right, I don't know if Eunice is going to give you a mark for showing zeros or not. I would specify depreciation is a non-cash item and show zeros for everything, not including the cash budget. Okay, it's like
I think
tax.
it's
Maybe you've covered tax modules like tax 2601 in that. Okay, so some items do have zeros, and then you actually get marks for zeros.
Yeah.
Okay, so I don't know if the same thing will apply to finance. It might or might not. It's worthwhile just showing it just in case.
Yeah.
Okay, and then the last question, or part of the question, taxes are paid in June. So, tax in which month? June.
June.
And that's it. Okay, if I sum up everything, okay, I get those answers there. Those are my total payments. Right, so now all I need to do at the bottom here is I need to analyze my receipts and my payments. Okay, so let me delete that. Okay, so my net cash flow is going to be my receipts. Where's my receipts? There's my receipts. Okay, minus my payments. There's my payments. Okay, copy that. Cross. Okay, so how do I get the net cash flow? It's the total receipts minus the total payments. Right, they told you in the question that the opening balance must always be what? 40,000. That's what they said. They said they need to maintain cash at 40,000. Remember that? We read that, eh? Okay,
Yes.
so do you agree in this month, in the first month, the balance at the end of the year, well, I started with 40 and then I paid more than I received, so the net cash flow was minus 16. Okay, so am I going to see external financing? Definitely, because I need to top it back up to 40,000. Okay, in the next month, this was a bad month. I had lots of payments and very little receipts. Okay, so again, starting with 40, ending with negative. Am I going to need external finance? Definitely. I need to make up the shortfall. Okay, in the last month, that last month was a good month. Receipts were a lot bigger than payments. Net cash flow was 240,000. Okay, so what balance did you start with? I still started with 40, but now I ended with 260. No external finance required. You got more than enough capital in that month in terms of cash. And that's just something else to consider because that's what they spoke about in the question. Okay, 15 marks for that question. And that completed it. 15. What is 15 out of the 70?
That's 21%.
21% for doing this. That's brilliant. Okay. You'd be so happy if this was an exam question, hey?
Yeah. Yeah, I'll be very happy.
Okay. Alright, just over 20% for a question like this. That's brilliant. Okay, so budgeting's not as bad. It's just a lot of interpretation. Okay, so and that's why I said the long question in this post paper they were nice. Because it was very different. Okay, so if you're expecting the credit policy and those types of things, this might be a shock because you haven't covered it. But now we've covered it, so now we have a good idea of which section is better. Okay, so this section is a lot better to be tested on than the other sections that we've looked at. Okay, 2016 papers were tough, or tougher, I should say. They weren't that bad, but they were more challenging. Okay, this particular paper was a nice one. Okay. Happy Melanie, any questions?
Yes. No.
Great.